Hello, class, and welcome to our fifth lecture series on financial accounting or principles of accounting. And I'm your instructor, Dr. Jamel. Today, we are starting a new chapter. But before going to the new chapter, we have our assignment 2. So, guys, let me know if you have any queries regarding assignment 2. So, let me ask one by one. Do we have any query regarding assignment 2? Or it was easy? Or no queries? I would be uploading its solution right after this class. So, number 1, Faik, any query regarding assignment 2?
No, sir.
Nivia, Mirko, Momo, Nana, Havarun, Venetia, Peranan, Oliver, Joao Paulo, Priscillo, Tara, and Mina. Any?
No, sir.
Hen, Sufyan?
No, sir.
And the only thing is that I'm not sure about my answers. So, like, if it ends up something maybe is wrong when I check the answers, can I ask you?
I would be uploading its solution right after the class, so you can compare the solution at least just one time. Just saw the solution so that you know where did you made any mistakes or anything that it is bothering you something. Still, if you have any question, we still have time after the class. You can talk to me, you can message me, or after this time we still have 5 minutes window. So on Jumo we can talk about that. Okay, so let's go back to our slides here. So we have a new chapter, chapter number 3, and that is accrual accounting and income. So our first learning objective is explain how accrual accounting differs from cash accounting. So up till now, we were discussing the accounting and accounting principles. We talked about accrual accounting principles like debit and credit. So what are the rules of debit credit? So let me just revise for you. So assets, if the account type is asset, then if asset increase, this is T account. Debit mean left side, credit mean right side. So if asset increase, it will be written on debit side. If asset decrease, for example, cash, account receivable, prepaid expenses, or fixed building, all those stuff. If asset account type increase, we write it debit. If asset account decrease, we write it on credit. Liabilities and honor equity. So left hand side is called debit, right hand side is called credit. So if liabilities and honors account increase, we record it on credit side, and it decrease, we record it on debit side. We denote it with DR, credit with CR. And there are exceptions that we talk about that, and we have a logic, dividend and expenses. Remember this one. If dividend and expenses increase, it decreases the honors equity. So we record it as debit side, credit side as negative, right? And what are the rules for journal entry? Always first write debit and then take a space and then write credit. And how we pronounce the entry from debit to credit. Whenever I say to, it means now we are talking about credit. For example, cash to sales. It means cash is going to be debited and sale is going to be credited. And there is a space here. Right? So that was a little recall from our last lecture. So now let's further explain the accounting principles. So what is the cash basis accounting and what is accrual basis accounting? So number 1, accrual accounting, it records transaction when they occur. So customer, you receive your services or you sell the goods to customer, but customer will pay you later. But when possession is transferred, the goods are handed over to the customer's sale occurred. So accounting principles stated that you need to record when possession is transferred. So account receivable to sales on the same day, maybe on today is, for example, 11th October, this transaction done, and on next day the customer pay us. So next day you record on that day transaction. So customer pay you back. For example, $100 good you sold to the customer, and customer say I will pay you tomorrow. So on 12th of October, you will record cash received and account receivable decrease. So cash to account receivable, $100, $100. So in accrual accounting, dates does matter. The matter thing is, the thing that matter is when the transaction occurred, you immediately record that. We'll talk about in our couple of slides, expense recognition, revenue recognition principles. Wherever in cash accounting, cash basis accounting, we only record cash receipts and cash payments. Accruals, we don't record. Customer pay you later, you don't record it. When customer pay you, then you record. For example, on 11th of October, you sold the goods to the customer, right? Sold goods to the customer on credit. In accrual, entry would be account receivable to sales. And on 12th of October, you record cash to account receivable. It means you recorded sales on the day it happened, 11th of October. But here you record when cash is received. So you record here cash to sales. Though the sale occurred on 11, you will be recording on 12 when cash is received. So what are the problem with the cash basis accounting? It is not practical. Why? Because credit is a part of normal day-to-day businesses, right? So many things you are purchasing on credit, many suppliers are giving you on credit, many customers are receiving our services on credit and they will be paying you later. So though there is a chain reaction. So sale occur, but money is coming afterwards. Sometimes like in Walmart, Metro, Carrefour, you buy spaces, you hand over, you place your goods to the shelf, and when customer pay to the stores, and then store give you the money, right? So sale occurred on the day. No, in cash basis accounting, you record the sale when cash is received. Maybe it takes 1 month, maybe 2 months, right? So the cash basis ignores important information, like what is my. So in accrual accounting, you can easily find out what is my daily sales. And you can also track what is my daily cash flow. Maybe sale occurred for $1,000, but cash in your account is right now $100. It will come after like 1 day or 2 days or 3 days, right? So that is the biggest difference between accrual and cash basis accounting. Plus, GAAP, the generally accepted accounting principle, the principles of accounting, it requires you to follow accrual accounting so that chances of fraud is minimized. So when you record on the day it happened, right? So it is very hard to go and replace or cut and make a reverse entry, fraudulent entry, right? For example, sale occurred on 11 October and cash is coming on 12th of October, right? But here in cash basis accounting, the cashier who received the money, he won't record it. He will put it in his pocket and he would say, customer didn't pay us, so you don't record the sale. But here, since You already record the sales. What is the entry? Account receivable to sales. This is debit and this is credit. So now on the software or on your accountant, he would be worried about this customer didn't pay us yet. And then you confirm with the cashier through telephone or through physical record checking whether he paid us or not. Then it is a little bit hard for cashiers or those who are responsible for receiving the cash to do some fraudulent activities. There are chances of fraud, yes. For example, customer need to pay you 4,500. You just recorded 450, and rest of the money you just keep it in your pocket, right? But this can also be traced through accrual accounting because the balance didn't match. Balance will say that this customer still need to pay us how much? 4050. And then you call to the customer will say that, look, I deposited 4,500 and I have a receipt. And then you go to the cashier and say that, look, you either this is a human error or either this is intentional error. But here in cash basis accounting, when cash received, then you record. That's it. And here you also record the customer name and data as well. Account receivable are our customers. On the back end, there are customer names and all those stuff. But here, no customer name, only cash received, cash to cash, cash to sale, that's it. So who received the cash and who paid the cash, nobody knows. Nobody knows the customer details, right? So it records the revenue when earned and expenses when incurred. So on the same day or on the date when it is incurred, even the time, which time of the day, morning, evening, or date, time, 1 o'clock, 2 o'clock. So it records everything. So you have a much more details or important information. But here you ignore important information, plus it results in incomplete financial statements, right? How is that? Because you have to make what is the accounting statement, for example, income statement, net income statement. It is for 1st of January to 31st of December. So you sold on 28th of December, big order, but the cash will received on next year, 3rd January. So you are making financial statements on 31st of December. So technically, the sale that occurred on 28th of December will be included in this financial statement. But due to cash is not received, you won't record it. So the financial statements do not reflect the true purpose or true figure during the year. Because 28th December belonged to this year, but cash received on next year, so it will be added on next year's sales, not this year's. Right? So this is the biggest disadvantage of using cash basis. Plus, that if this is so much disadvantageous, then why it is still used? So remember, this is only used by small businesses, sole proprietorship, small shop owner like noodle shop, like hair salon, one person hair salon, not a chain, right? Only barbers or small business owners. That's it. Ice cream sellers, small, not the ice cream chains, small business owners, that's it. Okay, or like street vendors, this kind of stuff. So let's talk about the accrual accounting and cash flows. So does that mean we don't record cash on accrual accounting? We do record, but when cash is received, we record. When transaction occurred, we then record. When cash received, we then record. So it means in accrual accounting, accrual accounting records cash transaction, yes. When cash received, so when cash is coming into the business,